A rate cut, September 17th. What does it really mean? They've made it so complicated. Hi, my name is Phil Grandy of philsgang.com, a 30-year stock trading education group. Let's make this simple. So, a year ago, when they did the same thing, what happened? Well, the Fed cut rates 0.5 point. But the 10-year Treasury, instead of going down, went straight up from about 3.6%, hit 5% just for a second or so, and then pulled back just a little bit. So now, is the same thing going to happen on the 17th? It doesn't matter. Rates are not driving this market. That's what they don't want you to know. Are you nuts? They're not. What's driving this market is massive stock buybacks. That's what's been driving this market. Example, 436 companies participated in stock buybacks, but only 20 accounted for about 60% of all stock backs. 20 companies. Now, the last 12 months, Apple has led $106 billion, a record. The IT sector is nuts. It dominated with $276 billion, and they still aren't stopping. That's almost 29% of the S&P 500 total. That's what's driving the market. Now, the labor market is everything. That is what's supposed to drive everything. But think about this. The economy is only as strong as your labor market because it drives what? Jobs. How many jobs we have? Wages, interest rates, economic growth. I mean, everything. It influences Congress as to economic policies. Investors need it for investment strategies, always about the labor market. Now, Powell says he's going to cut rates, even though there's inflation, because he's concerned about the labor market. No, don't believe it. That's not what he's concerned about. He knows the only thing that's driving this entire stock market is stock buybacks. As long as we continue to have stock buybacks, he knows the market will continue to rally. And he's there for the market. He's there for Wall Street to rally this market. That's what it's about. Think of the contradiction. Powell's cutting rates for the wrong reason. He says, well, I'm going to cut rates because it'll create jobs. Wait a minute. What do you mean it'll create jobs? Are you nuts? First of all, he's saying, well, if I cut rates, then people are going to go spend, they're going to consume, and then all the products they buy, they got to be replaced, they'll get jobs. Is he nuts? That's totally BS. No. We have record delinquencies, mortgages, auto, credit cards. We have personal bankruptcies up from January, up 25%. Small business bankruptcy up 45%. No, that's not why he's cutting rates. He's cutting rates because he wants to make sure that we keep the stock buybacks going, to make sure that we can keep printing money, give it to the banks turn around, give it to the CEOs, so they can keep driving the stock market without retail sales increasing. That's correct. Now, think about it. If the economy's so good, we keep hearing that economy's good. Well, wait a minute, if the economy's so good, we have 1.5 million fake jobs just revised away. We had a 600,000 record part-time jobs replace our 375,000 full-time jobs. Now, if we've got such a strong economy as we're being told by the fake Business News Network every day, then why was June then revised to negative? And here's the big one, JOLT. That's the one you have to follow, job openings. Since 2020, job applications are outnumbering applicants. Think about that. So in other words, we have everybody looking for a job, but no one's getting a job. So the bottom line is the rate cut, if what happened a year ago happens again, where all of a sudden we cut the Fed rate, but the 10-year Treasury yield goes up, it'll hurt the market a little bit, maybe for a couple of days, but as long as you have this, watch your stock buybacks, watch your margin debt. As long as they keep providing margin debt, and as long as we have stock buybacks, and as long as the Fed keeps on dropping rates to make sure companies can borrow money cheap, this market will continue to rally no matter what happens with the rates. I know that sounds strange, but think about it. This market since 2009 has been going straight up on stock buybacks and then increased money supply. One of those has got to stop in order to enter into a correction. They won't even call it a crash anymore, or correction. You know what you're calling it now? Repricing. They don't even want to say there's a crash anymore, because everybody catches hell when they say, oh, there may be a crash. Oh, you get all kinds of hate mail. Oh, there may be a repricing. So on the 17th, just watch the stock buybacks, and you know exactly where the market's going. Once those stock buybacks start contracting, then you'll get a correction. That's not going to happen for a while. Be prepared, though. If it does, you got to learn how to sell short, and we can help you with that. So that's my message. My name is Phil Grandy, philsgang.com, a 30-year stock trading education group. Hope this helps you.